the earnings vacuum creates the scenario in which they're nervous. There's no question that's the case, and that doesn't matter whether you're a bond or equity fund manager. I know it's a pat phrase, but solvency has been the primary concern, for both equity and bond managers. So I would say there's been an upgrade to their portfolios. If you define upgrade as companies with strong balance sheets, possibly net cash on the balance sheet ideally, and access to credit. And I think that's been the three drivers. And in most cases, they've obviously been able to do that. You've been able to get away rights issues in equity markets. You've been able to issue bonds quite readily. The new issue market, particularly in credit, is very, very strong. The calendar's very strong, and people have been taking up the primary issuance. So the navigation has been to focus on companies bolstering their positions for what is an unknown, which is the next 3 to 6 months of what is the level of economic activity. We started with a zero revenue line for many companies. That will obviously change notionally as lockdown, at least this phase, eases. And it's the bridge between A and B that they're mostly focusing on. It's meant that fund managers who have been heavily focused on disruption, on growth companies, have remained there. If anything, there's a belief that those trends have been reinforced by this lockdown, leaving the value managers, that those have been trying to focus on cheaper stocks, struggling. The value has been an atrocious place to be, both in January and February, and indeed in March and April in the recovery. And in credit, the credit quality continues to push up, mostly...
Peter?
Yes.
Peter, very good morning to you. We all think that this market looks frothy, given what is going to happen to the economy for the rest of this year and possibly for the next couple of years as well. But I can afford to do that as a journalist. You can afford to do that as an observer as well. But fund managers have to do something with their money. Regardless of how frothy, exuberant, overly optimistic this market looks, they've got to do something. They can't just sit on the sidelines for the rest of the year. Or can they?
No. Well, first of all, I mean, I think I was last on just before the 19th of March, and from that perspective, I remember reciting the fact that, actually UK, European and rest of the world equities weren't frothy. They weren't on crisis multiples, but as Stephen, I think the UK all share was just about 11 times. That's not expensive. The bugbear remains the US. So no, the answer to your question is none of them are holding cash if they're running relative products. You're absolutely correct. And most of the world is relative long. In other words, they have to be invested and they have to beat a benchmark. So what I would say within it is that if there is a bias, the bias has been to focus a little bit more on your Tesco and a little bit less on your deep cyclical. And the one thing that's been interesting in this entire piece is the financials, which have been wholesale appalling. I mean, the banks have been dreadful, and they continue to be pretty dreadful. And if we're going to have negative interest rates pushed into the whole of the world, I can't see them looking any more compelling. So, yes, they have to be invested. They're holding the nose, Stephen, because if they're supposed to be fundamental investors, which they are, and they're supposed to focus on the earnings, both the quality and the long-term nature of those earnings, it is very difficult to get enthusiastic at this point, because the revenue line, not just the earnings line, the revenue line is an unknown in most cases. Not every case, obviously, not your supermarket. 60% of the UK economy is open as we stand here today, and that's gradually opening up more and more. But if you're an airline, if you're in travel, if you're in any of the hospitality areas, if you're in anything with second and third order effects off the back of that, it's been more challenging. But interestingly, and I send those notes across to you, both of you, managers have not been doing violent surgery on their portfolios either. Again, to reinforce the point, you were here before February and March started. You were either value manager who thought the financials were cheap, or you're someone who continued to want to purchase Amazon. So there has not been radical surgery. Unlike 2008, when there were opportunities galore and managers were changing portfolios, there's been no aggressive change to this, to their portfolios at this point. Exception there being bond managers who have definitely improved the quality of what they're buying. They're buying higher grade bonds.
Peter, one of the reasons why investors got back involved in the market so quickly was the amount of stimulus coming into the system. We saw it through the CARES Act, and we've seen it through other measures from the Fed and more globally from central banks also reducing monetary policy and throwing more QE at the system. What does that mean down the track, though? Because clearly it feels as though there's more coming again. The United States is talking about another $3 trillion in stimulus measures. We're still waiting it out here in Europe. Does that mean we get so much stimulus at the system that we do minimise some of the damage come 2021? Well,
interesting you say, Karen. First point you made, investors got back involved. Actually, very few did. If you look at the trends, well, question we're asking every manager since literally February is, what has your flow been in your funds? And actually, for the active funds, it's been quite negligible. It has been the passive managers who've benefited. It has been individual retail investors who've been buying en masse, and it's been some of the macro and CTAs, so the systematic strategies, who have been buying this marketplace. So, interestingly, again, the pros have not wanted and been excited by the possibilities. I think in Europe and rest of the world, possibly, but again, the US, the big daddy, has been expensive and remains expensive. The answer to your question on the stimulus, that's the bridge, that's the gap between the two. And so managers are staying involved, Karen, because it is the tug of war between the stimulus and the fundamentals. The fundamentals are going to stink. There's no question the earnings are going to be extremely challenging. And the bridge is the fiscal stimulus. And that is why there is this situation, as Steve alluded to. Managers are staying invested because why should they know the answer to that question either? Why should any of us know the answer to the question as to whether the fiscal stimulus is sufficient size to overwhelm what is an unparalleled crisis in the sense of revenues disappearing, something that has not happened for over 100 years. No one has ever been prepared for this thing. So we're working out whether we have to dismiss just this year's earnings or if this is coming back again and we have to start dismissing 2021 earnings. And you have to ask yourself the question about why buying the US forward here, PE, the highest ever, by the way, PE for the United States equities, is the right thing to do. And the answer to that is, against the backdrop of stimulus, managers are just going to literally hold the line and basically see what happens. Because how do they know if we have to start dismissing 2021's earnings as well? If this comes back, if we have a second go at this, then those multiples aren't the right multiples. If it isn't coming back, the fiscal stimulus creates the bridge, and in fact, we're probably clear. And that's the thing they're wrestling with.